It's a special week for us. Of course, we are celebrating our 19th birthday. And you have been with the channel for all of those 19 years. In fact, personally, I remember you're the first guest I spoke to when I joined CNBC TV 18. So thanks a lot for being with the channel for so many years. Your thoughts on the recent market move and the recent volatility?
Well, Anuj, it's a pleasure to be here, especially on this special occasion. Wishing the channel a very happy birthday, and to entire team CNBC TV 18. I think you guys have done a fantastic job. And it's great to know that it's been a marathon so far, 19 years, and hope to remain associated with the channel for maybe the next 19 years as well. So have a great year ahead, and best wishes. I think in terms of the market, I think we probably still remain in choppy waters. I think volatility is still going to be there. And it doesn't look like that things have completely settled down. And I think the next few months is going to be completely event-packed. There's very less to look forward to in terms of earnings. But there's going to be a whole host of macro events, global events, local events, I think, which is going to basically drive both the sentiment as well as the direction.
You know, this is, we know volatility, but this looks like you have to wear a helmet every day. Crude is at 58, it is at 86, rupee goes to 69, it goes to 74, and stock markets have always been, you know, in this yo-yo. There's 800 on the Dow. I mean, how does one handle this? What is the overarching feel you're getting, that at these dips you will be a buyer because growth is still there, or is even that growth picture now dimming?
Well, what it looks to be the case is that clearly global growth is kind of in a way scheduled for some kind of a slowdown. And that's essentially the bad news. The good news is that India was never really participating in that global growth. We were still kind of entirely or significantly domestic-led. So in a way, that's basically the good news. And what this slowdown in the global growth will do is to ensure that commodity prices remain capped. And that, I think, is positive news from an inflation point of view, as well as margins for corporate India. So that's really the big positive from here. But in terms of the day-to-day movement, the volatility, I think that will remain, because we still remain significantly correlated. I mean, you know, the economy could be decoupled, but clearly the markets in the very short term are not necessarily decoupled. And I think the big risk, while we keep talking about elections and RBI policy and some of those kind of events, but clearly I think the global volatility is something which will continue to, in a way, prevail upon even in our market.
In fact, Nilesh was talking about the global slowdown. All the global related stocks are under pressure today. Whether it's Tata Motors, whether it's Motherson Sumi, Bharat Forge, you know, all of them down about 3-4%. So this growth scare issue is real. As somebody was saying, you know, not just a VIX, which is a volatility index, you now need a TRIX, which is a Trump volatility index, because you don't know what he's going to tweet next. But having said that, do you hide in the local, in the domestic consumption related stocks, because even there is a slowdown that's underway, right?
Yeah, I think the big challenge with domestic consumption, especially the consumer staples, clearly is valuations. You know, when you have stocks trading at 50, 60, 70 times earnings, I mean, despite the fact that some of them have corrected by 10, 20%, but the valuations are still very high there. And what it could possibly be is that maybe for a few more quarters, you could see stock prices just meander along. There could be some of those corrections, and I think wait for earnings to really catch up out there. Maybe one area within domestic demand which still looks attractive at these prices essentially is cement. That's one sector which I think will benefit because of all of these things, because their margins have got impacted in the last year or two, primarily because of surge in crude oil prices, petcoke prices, all of that. Now that's kind of in a way sobered down crude oil prices, and I think therefore margins could turn positive for the cement sector. And of course, in addition to that, of course, the core demand is still intact. A lot of cement companies are talking of growing at 8 to 10% volume growth, which I think is great news for the sector. And with prices off significantly, clearly there is value out there. So I clearly think that we see long-term value emerging in the cement sector as a good proxy for India's long-term growth potential.
Okay, the stock of this year has been TCS in the large cap IT and has made a massive move. Mid cap IT has also moved, but you still back the story. Rupee tailwind, a lot of people say perhaps might be over, but purely from the business point of view, valuation point of view, still a good story, you reckon?
Yeah, I think IT is still good. Clearly, we've seen even when the US economy was really not firing on all cylinders, even in that environment, our tech sector at least grew. And I think it grew, of course, in single digit. Maybe right now they're probably at the cusp of that 10-12%. If that 10-12% growth happens, it gives them operating leverage. The one big challenge for IT companies going forward could be basically the wage costs, the cost, because clearly if you see a lot of companies are coming down to India and hiring. I mean, there was like Samsung talking of hiring a few thousand engineers. Microsoft is going out there to the IITs and offering them, huge salaries. Now that itself is going to put a lot of wage-related pressure on some of these larger IT companies. Attrition is very high. I mean, their attritions are like 15-17% is the attrition run rate for some of these larger IT companies. So these are some of the risks which one has to be aware of or cognizant of. But otherwise, on the whole, I think IT should be a relative safe haven when we see this kind of volatility.
Okay, you'll go for the banks? I mean, corporate banks is everyone's favorite.
No, I don't think so. I clearly think that the sector is going to have challenges. Clearly, I think...
You don't think they've come out of that big NPA challenge?
No, they could have come out in the sense that probably for the timing, I think the crisis has been averted. Let me put it that way. Okay. But these are things which just don't die down on an overnight basis. There is a long grind which goes into it, because what typically will happen is that there would be some kind of, I would say, regulatory measures which will come in, which ensures that these kind of incidents don't occur again. And that, in a way, could dampen growth to some extent. Number one. Number two is that in the last couple of years, a lot of banks have come up. Okay, some of these microfinance companies have converted to a small finance bank and all of that. And you see a race for all of them to kind of garner deposits. I mean, I was just seeing an ad today of Ujjivan offering 8.6% on fixed deposits, okay? I think that is going to build up competitive pressures. I think all the banks will just want to go out there and try and soak in as much liquidity as they can, which will somewhere put pressure on margins. So I think one has to be very, very careful about banks. Wait for more attractive price points to get in there. And when you see quality banks at more attractive prices, that's the time to step in.
So you would be still with the retail guys?
I think the retail,
the proven retail.
The proven retail, I think, is a good place to kind of be in. And I think clearly tier 2 NBFCs, simply avoid them.
Okay, so avoid tier 2 NBFCs. But you mentioned that you like cement a lot. You think that's the attractive play. Anything else that catches your eye? I mean, any of the beaten down sectors like telecom, what would you be looking at as a big standout?
Yeah, I think life insurance, I think, is a great place. Okay, I think that's a great place to be in. Stock prices have corrected for some of the life insurance plays, but I still think that's a steady state kind of a business. And I think competitive pressures would be relatively less in that space because you aren't seeing new insurance companies really coming in, whereas the long-term potential still is intact and is, I think, growing organically in a significant kind of a manner. So I think life insurance as a space clearly stands out there. Also, we've seen in India, like, the entire financial space, every decade you see a new set of sector or subsector emerge. So in the 90s, it was NBFCs. The decade of 2000, 2008, it was the brokerages and investment banks. Then essentially it's been private banks and some of these NBFCs. I wouldn't be surprised if the next 10 years really belong to insurance as a space. So I think that's a very, very good space to be in from a long-term perspective.
That's a great observation. Each decade, one kind of the finance space. What about good old consumption? Is it too pricey?
I think the staple space is too pricey. The core FMCG kind of companies, I think out there, these valuations are 50, 60, 70 times. And I think while, of course, we've really liked this space, but I think one has to be now very careful of valuations. And I think what can go wrong, one has to just go back and look to what happened in, say, the year 99, 2000. Everybody today says that everybody will have to buy a soap or a shampoo every day, or have some innerwear or buy the next set of clothes. I remember 99 also people saying the same thing, that every Indian will have to buy shoes, every Indian will have to shave in the morning, all of that. And look at what happened to stock prices of Gillette then. What happened to stock prices of HUL.
I remember two-digit HUL. Exactly. That I think was 2005.
Well, yeah, so I think one has to just be, it's very easy to get carried away about growth and saying that I see visibility, but visibility at what price? I think that is very, very important. I think versus that, some of the consumer appliances, consumer durable, their stock prices have in a way corrected significantly. The correction there has been more like 25 to 50%. in that space. I think that is far more attractive. Valuations have come down to maybe, you know, in the 30s or maybe early 40s in terms of P multiples, and I still think the growth potential is intact. So versus consumer staples, I think consumer durables, consumer appliances is a much better place to be in.
In this space, anything that you would want to take a punt on? Of course, we all know price to book value if we believe the book, but any bets there?
Well, the entire pack, I think the single biggest factor one should look at in this is that, do you believe if the RBI is going to cut interest rates, okay, going forward? If you believe so, then I think this should be a place which could kind of end up being an outperformer.
But that could be a trading bet.
It will be a trading bet, but if let's assume the view comes out that basically yields have peaked, okay, and if the RBI is all set to cut interest rates, especially given the way consumer price inflation is so sober, it's at around 3%, and the gap between the US interest rates and interest rates here is around 4%, whereas that's not the interest rate inflation differential. So if one keeps that factor in mind, it's quite possible that in 2019 we could actually see rate cuts happening in India as well. And if that were to happen, then of course the PSU banks will be a very, very big beneficiary. And it may not just be one trading move, but maybe for a year or so you could actually see that entire pack becoming an outperformer.
Okay, so then before we let you go, what is your, if you know you had to do some crystal ball gazing, what do you think the outlook of 2019 could be? I mean, 2018 is almost written off. Nifty hardly grew. Mid caps are down 20%. What's the prognosis?
So, well, I think, you know, 2019 could be like a glass half full, half empty. I think the first half looks to be a period of consolidation. It's quite possible that we could consolidate even further between now and the first half of 2019, say by May or June. By that time, a lot of clarity will emerge in terms of elections, in terms of interest rates, and all those kind of macro variables I think should be there. I think based on that, I think the second half of 2019, I think could be significantly better. So this period of consolidation, correction, etc., I think on an outer limit should kind of end by the first half of 2019, and the second half of 2019, I think we should be back to our normal good old bull market days.
Oh, that's very positive, but you know, it's giving me one doubt. If you think that the rate hikes have peaked off and there could be a trading bounce in PSU banks, essentially that will mean you're not very positive on growth. But if you're positive on growth, you can't have rate cuts.
No, I think if you really look at it, Lata, I think in India, at least the RBI, what it has been doing, saying is that for us, our changes in interest rates will be a function of inflation. Okay. So you can't have a situation where inflation is under control and we still continue to follow a very tight monetary policy or high interest rates.
Yeah, so you expect cuts or at least peak off.
And even in terms of growth, I think when India grows at say 6.5%, 7% and all that, that's really not what we all aspire to be. You know, I think for us, we probably need growth rates of at least 7.5% to 8% or maybe north of that as well. And I think an important trigger for that could be basically cut in interest rates. So I think the way inflation is moving, I don't think we can afford to be at this high interest rates. We need interest rate cuts. And I think that's something which could very well play out in 2019.
Okay, you want to leave us with one birthday gift, one stock for our viewers, a long-term stock that you would advise to our viewers?
Promised our viewers. We said it's our birthday, but you're going to get the gifts. And one of them will come from Nilesh.
No return gifts.
No, we won't give you a return gift, but you have to give us a birthday gift, right?
No, but no, I think clearly, I think it's still, I probably think more look at sectors right now. I don't think I'd want to get into an individual stock, but I think clearly, I think cement is one area where one needs to really watch out for, and consumer discretionary spend. I think these are the two big areas to really watch out for.
Cement, consumer discretionary, you spoke about them and you analyzed them at length for us, and insurance.